description of OPEC 25 years ago. OPEC's role in the market today is exactly the same as it was 25 years ago. We can read a lot in the press about how things have changed, how OPEC has lost its mojo or whatever. Maury didn't see it that way. I don't think he would see it that way today. I don't see it that way today. But that's not fair because that's too old. So let's get some more contemporary evidence, and I'm going to turn to another person who knows far more than I do about OPEC and to bring his knowledge to bear. He says, by my assessment, high prices were unsustainable. If prices had not collapsed, OPEC production might have all but vanished. Continuing on, he says, inroads from competing sources, oil and non-oil, would have continued at those high prices. How low will prices have to be to ensure growing future markets for OPEC's oil? $14 a barrel? That's pretty radical. But then again, we're talking about forestalling something that's pretty radical, and that is having essentially a stranded asset. OPEC doesn't want to see its oil reserves stranded. And so we have to think about low prices as an effective mechanism that could be attractive to OPEC going forward. But again, I said this was more contemporary only by 2 years. My old professor, Tom Stauffer, Harvard University at the time, was again prognosticating OPEC hasn't changed, facing exactly the same problems. Maybe the world's economy has grown, maybe there are different sources of supply. There are always constraints, supply and demand. OPEC is at the same vortex now as it was many years ago. Well, I want to now really turn to my evidence that I would bring to bear on this, and that has to be understood really, I think, at the most basic level through the consideration of balsamic vinegar. And you can see that here I've got really almost the whole family of the DeLassie's balsamic vinegar. Here's a bottle shown on the screen right here. I can tell you this one is aged for 4 years in wooden barrels to give it the essence that you want in a good balsamic vinegar. But this one is aged for 20 years in those same wooden barrels to give it more of the essence of what you want in the balsamic vinegar. This one costs more. It's got to. It's been left in the barrel for 16 extra years, not generating any revenue. So when it is sold, that's when it has to make up the revenue. I've put that into a simple arbitrage formula. There we've got the two bottles, and the 4-year-old sells in my market for $3.69, the 20-year-old for $12.99. Those two prices bear a particular relationship. They're not drawn out of a hat. They're not chosen randomly. They actually satisfy the intertemporal arbitrage equilibrium condition that any seller of a long live asset must respect, and that is that the oil in the bottle, the vinegar in the barrel, must appreciate at the rate of interest, or else you're losing value. And that's exactly what happens between these two bottles. Using an implicit discount rate of 8%, the present value of selling this bottle now, bringing in $3.69, is exactly equal to the present value of selling this one 16 years later for $12.99. If that weren't the case, the lessees should take this one out now and sell it earlier, if the present value, or vice versa. So that's the arbitrage argument. Exactly the same thing applies to oil left in the ground. There's no difference. It's a different commodity. But let's consider the Saudis' position back at the end of '74. People will say, no, defend the price, cut the production of oil, leave that barrel in the ground until eventually it can be produced in the future. That way you'll get $100 today. You'll defend that price on what you sell today. Now, how much will you get when you eventually bring that barrel out and put it on the market? And given the Saudi reserves, it's going to have to stay in there for a very long time, let's say till 2050. Could you think of getting $1,400 per barrel when you eventually sell that barrel? I doubt it. That's not what I'm hearing at this conference when I hear decarbonizing the supply chain, but that's what you would have to get to satisfy the same arbitrage condition. Oil in the ground has to appreciate at the rate of interest, or you are undercutting the wealth of the nation. The patrimony is not being exploited. You're not monetizing that asset. So $100 per barrel would be very difficult to defend from a Saudi point of view. They have too much oil. When are they going to sell it? If they don't sell it, what good was it? If you can't sell it then, sell it now while there's still a market. It may take a lower price. I read now that the Saudis and other OPEC members may be thinking, okay, 100 is not good. Maybe $60 is good. How does that look on the arbitrage scale? It does not pass the long-term test, in my view. Sell it today for $60 would be equivalent of expecting to get $700 per barrel later in the life of those reserves. That isn't going to happen. I don't. Maybe some people here have contrary views, but I'm willing to argue that that's never going to happen. We're not going there in the future with the Saudi oil. So the Saudis may be concerned about the longer-term production planning. So how do we get here to $100 oil in the first place? That's because you can have fun with high prices in the short run. And OPEC had a lot of fun with high prices in the short run. For the reasons that Professor Hafner indicated earlier, that was that there are long lead times and there are inelastic responses that don't show up for a while. But in the long run, it's negative, and it leads to the stranded asset problem if the high prices trigger competing sources, technological change, differences of lifestyles, and change social agendas, all of which has happened. Well, the short run is over and the long run has arrived. And I don't see high prices of oil. I don't see the next cycle of high prices coming. Although it's been true in the past, I think we're through that. I still think that OPEC has the role to play of defending a price, regulating production, but it's not going to try to defend $100 because it will be out of business before most of us go on, to our retirement, long before that. So there'll be a lower price level coming in the future. I think OPEC has learned the lesson, or maybe they haven't, but it's too late. It's too late now. It's already history. If they want to make up for this mistake, they should produce more now. You have to begin monetizing that asset. And to produce more now, they're going to have to let the price be lower. That's the only way you generate demand and win back demand from these competing sources. $100 is out. You also have to expand investment in new capacity. I think the Saudis would do well to produce more than 12.5 million barrels per day. And they could, it just requires investment. Look how production ramped up in the U.S. Saudi has shale oil and shale gas too. Nobody's even talking about that. They can produce a lot more. If they don't do it now, they're never going to do it. It's their choice. I'm from Texas, and apart from pledging that Houston is going to recover, and you're all invited to the U.S. conference next November in Houston, we'll show you the proof of our resilience. I would also say that I know that every time OPEC discusses further continuation of the cuts with Russia or with anybody, every Texan stands up and cheers because this is the best news possible for shale oil producers. Thank you very much, OPEC. And it seems to me that that would be the strongest signal to OPEC that they're making a mistake by continuing those production cuts. Who are you helping? It's pretty clear. It doesn't require an explanation. Now, you can say I'm standing here in hindsight criticizing these decisions that were made formally. I brought up a slide here from my archive. This is research that I did back in 2005, and I will swear to that, and there's one person in the room that could back me up because Monet Urchel, I made this presentation with this slide at the Dallas Federal Reserve Bank back in, I think that was in 2007. And this was the result of my modeling that incorporated two key aspects, and Professor Klaus Mohn mentioned these yesterday in his talk about what a good model requires. One, it requires endogeneity, that sustained high prices will tend to trigger technological changes, and that they would potentially be disruptive technological changes that could happen rather quickly and be fairly irreversible. So I built those into a model back in 2005 when the oil price was already climbing up towards 100. And I found that for the long-term wealth maximizing benefit of OPEC, that a price higher than about $55 a barrel would undercut their long-term interest because of the destruction of market through disruptive technological change and substitution of other fuels, including gas, and also a reduction of economic growth that would come about by high prices. So we say $55 a barrel. I gave this presentation actually in the spring of 2008 to the Independent Producers Association of America when the price was at $140, and I'm still saying 55. There were a few chuckles around the room and maybe some indigestion after the lunch that came by. But even stronger than this, I want to show that the gains to OPEC members are distributed asymmetrically. And so I broke that wealth measurement down into three components. The revenues that the Saudis would get through their sales, given their market share, and the tendency of other members in OPEC to maybe exceed quotas. And then for the other core members, being Kuwait, Qatar, and the UAE, and finally really the non-Persian Gulf producers. And you can see that everybody but the Saudis, that $55 looks good. Not for the Saudis. They have too much oil. They get too small share of the market because they're the only ones that have strong discipline. Their costs are too low, so they're postponing more rent than the other producers. It looked to me like $35 would have been a good price for them back then. If they had chosen either of those prices, we would not have shale oil today. We would not have been through the cycle that we've seen playing out. But I think now it's too late. We've done that. We've been there. Nothing has changed much, in my view, since I did that initial analysis. There's conflict within OPEC regarding price preferences for good reasons. It's because the situations, both demographic, economic, and resource-wise, are different across the members. They're not aligned. And up until that moment in October 2014, I thought the Saudis were bearing a disproportionate burden of the compromise. They were acceding to the higher price views of other members for the sake of cohesion, and to avoid the risk of stranded assets. I thought they had learned their lessons when they had made the announcement that we embrace market share. We have to produce our oil. They said that in 2014. I thought, okay, now we're off to the races. We will see low prices for a long time. I frankly was surprised then to see that reversal come. But I tell you, OPEC has to go back to a market share strategy or they're just going to get pinched out. There's no choice. It's not a choice for OPEC. The choices have already been made. Now they have to live with the consequences. So thanks very much.
So Jim, thank you very much. I think we have seen three brilliant speeches. First, Kostas. His main message, I would say, was many infrastructure projects exist and are going to be realized, but perhaps they are not economical. Manfred talked about supply risk, but he mentioned that this is a bilateral problem. There are also demand risk. And of course, maybe I would add my comment and say if the supply is not assumed to be secure, then investors in the gas demand infrastructure, that means gas fire stations or the gas heating systems, will drop, and this of course hurts the supplier more than the consumer on the long run. And that's the same message about Jim. He says high oil and of course gas prices in the future are challenged by technical progress. So my overall conclusion about these three speeches, compared to my first question, do we have a change from supply, securing supply, moving now to securing access to the market? I think the battle of securing access to the market will be lost on the long run because of technical progress. I think this is the contents of these three speeches, and I assume that you have questions or comments. Please, you have the, yes.
David Knapp from Energy Intelligence Group. First of all, I congratulate all three speakers on some very well organized, very clearly stated, and very important presentations. But I would like to say, as usual, I agree with almost all that my friend Jim Smith said. The one thing I don't agree with is that I don't see any need whatsoever for Saudi Arabia to add new capacity. The key term here is maximum efficient rate. And Sadat al-Husseini, who used to run the upstream for Aramco, always says, well, no, you're wrong. They're not going to increase their production because it's very difficult and adding capacity is expensive, and why would we do that? I think what's going to happen is that they will produce well above maximum efficient rate at Gawar and otherwise, because what are they doing? You did make the point indirectly that the idea that they're saving oil for 2080 or 2070 makes no sense in the kind of market that we're now looking at. And when you look at Vision 2030, Mohammed bin Salman, now Crown Prince, I think gets that. Are they going to say it? I gave a speech at Jesus Orali's conference in Mexico where I said, high oil prices are good for Saudi Arabia before the IPO. High oil prices are bad for Saudi Arabia for all the reasons you excellently pointed out after the IPO. And so I think what you're going to see is not capacity additions. You're going to see things running down. And I was telling Manfred that I have a version of that Saudi Arabia does not want to be remembered as the country with the largest stranded asset in the history of the planet. Thank you.
Maybe I would ask the three speakers to come to the floor, because then it is easier for the discussion. Podium.
Yeah, Georg, can I respond to that?
Yes, of course.
I would only disagree to the extent that in the U.S., the maximum efficient rate, which has to do with kind of the geophysics and the petroleum engineering, with the rate at which you withdraw and what that portends to the long-term physical recovery, was all the rage in the U.S. in the 1940s and 50s, and it was pushed by the engineers, and it was finally overruled by the financing sector. That is, what we want to maximize here is the value of the reserves, not the volume of the reserves. And we no longer hear about maximum efficient rate in the U.S. That debate was lost. Maybe it hasn't been lost in the kingdom yet, but anyone with a degree from Wharton should recognize the same factors in the long run. And yes, maybe high prices are good for the IPO, but I think the investors have to be very short-sighted to be fooled by high prices in 2018 when they look at the size of the reserves, when they listen to the discussion of decarbonization, when they incorporate the potential risk from climate change legislation. So.
Yes, there is a question over there.
Thank you again to all three speakers, but this question is specifically for Jim as well. I have actually a quick comment and then a question. The comment, sorry, I'm David Daniels from the U.S. Energy Information Administration. The comment is that I thought your talk was very unfair. Here it is an hour and a half before lunch. I'm hungry, and you were talking about oil and balsamic vinegar. And now I've got a hankering for a good caprese salad, and I really hope they serve one at lunch. So that was extremely unfair. But the question was to follow on from your analysis, which you showed was before the price run up in crude oil to $100 a barrel for 4 years in a row. And your analysis was based on what price OPEC would want to maintain in order to prevent all those things which happened if the price ran up. If you rerun that analysis now that the genie is out of the bottle, what would the optimal OPEC price be now?
Yeah, it's a fair question. I haven't done the analysis, so I can only tell you what I think would happen, and that is that the prices were subdued in the previous analysis due to the risk of a greater supply. Now we've got the greater supply. I don't think that there would be any increase that would be emerge from that analysis in the indicated price level. It might even be lower because now you actually have an increasing supply at a lower cost than was anticipated 12 years ago. I couldn't hear you. Say?
But does your 55 go to 20 or 10 or
well,
2?
Or Tom Stauffer said 14, maybe. All of the above, none of the above. I don't know, but personally, I would not buy into a project that's going to require more than $50 a barrel for the indefinite future. Below that, who knows? And I do have a little of the vinegar if there's none out on the table.
Yes. There is a question over there. Yeah. Excuse me.
Thanks. Dawood Ansari from DAW Berlin and EADP. First, thanks a lot for all the excellent speakers, and maybe even much more thanks to the first question, because it's to 90% what I actually wanted to ask, and also, of course, for answering it. But there's one remaining question, because as you've already mentioned, the Aramco IPO is actually exactly the attempt by Saudi Arabia to start into cash in their future cash flows. However, as you've also mentioned, it's a quite dangerous point actually, because as soon as the investors will actually start to anticipate that there might be a future of prolonged low oil prices, then the market valuation of the company might actually be even heavier strike to the country. So I was wondering, what's your opinion on what's actually the efficient stake to take in this dilemma, doing the IPO or not doing it, or how to realize it efficiently? Thanks.
Yeah, I wouldn't presume to advise the Saudis on that question. I do understand that they're also concerned about that the IPO might bring greater transparency, and it might be a form of enhancing the governance at Aramco, which would be quite apart from realizing or monetizing the value of those future reserves. And I'm sure there are many counter arguments that are, and we read about them in the trade press, but where it will, fall out in the end, I don't know. I do think there will be an IPO.
A question here.
I have a question for the first two speakers, Manfred, Hafner, and Kostas, Andriosopoulos. You both touched upon the recent US sanctions and Nord Stream 2. And I was wondering, could you elaborate on that and say, first, what do you think the motivation of US LNG export to Europe play in the motivation for the sanctions? And secondly, what effects will it have on Nord Stream 2 going ahead?
Well, I think this is for Kostas.
Well, it's not an easy question, because first of all, the sanctions on Nord Stream 2 have been initiated by Congress to the first place. So not really driven by the US exports, because when we're talking about US LNG exports, there are a couple of projects, some of them are directly affected by the sanctions as well. The other competing projects of LNG projects that exist in the US at the moment as at the project stage and not at the production stage. So it's not really a straightforward question about whether the producers kind of push the sanctions towards the various European players here in the US, in Europe, for Nord Stream 2. I think that Nord Stream 2 will go ahead. There are problems, there are issues, but as you mentioned, maybe at some point ago in 1980, Europe still had what it takes to go ahead with this kind of project that makes sense economically, and because it is, at the end of the day, the economic viability and the commerciality of the project that makes sense, it will go ahead and will be built. And we have seen that from statements all the way up to Angela Merkel, to the CEOs of all the major European companies that also at the same time, most of them operate in the US as well, and they have big stakes there. So I was with the CEO of Eni recently, and I can tell you he's in a tough spot because they have a very big business in the US. Total is in the same situation, and they are all kind of supportive of Nord Stream 2. So at the same time, you see this competing interest, and my last comment would be that even the Rex Tillerson, that now has the position of being the Minister of Foreign Affairs, or the head of the State Department, has been one of the US citizens, businessmen, that they had a very, very strong relationship with Russian companies. And ExxonMobil has been very highly engaged in a number of projects in Russia. They have been excluded from the first sanctions that were imposed to Russia for certain cases. And now they are facing issues internally as well in terms of the second round of sanctions that exist. So I don't know. It's not an easy equation to solve.
Manfred?
Thank you. Yes, indeed, it's not an easy issue. I do think that the fact that the US wants to become a major LNG exporter is part of the equation, even though it's not that simple as you say it. And it's not just about Nord Stream, because when you take this sanction by the world, there are many projects in Europe which could be affected. which, by the way, shows that there seems to be quite a collective approach in Europe after many years on maybe to stand up against these sanctions, because it's not just about Nord Stream. Nord Stream is very controversial among European countries as well. But now here, these sanctions, they could affect what Eni does in Egypt. It could affect many other projects. And why should Europe be a collateral damage for some American sanctions which they want to impose to Russia? Furthermore, maybe it would be interesting to have your opinion on from an American point of view, how you see this.
I think, your view is certainly justified that the Europeans need to do what is in defense of their own interest, and that may not agree with the U.S. interest. There's very divided views in the U.S. on the use of sanctions, and sometimes in surprising ways. I mean, Rex Tillerson, as CEO of Exxon, was one of the prime beneficiaries of the ability to invest in Russia. But he was the sitting Secretary of State when the State Department affirmed that the sanction would continue. And so I think that this decision is going to be based on principle, not on individual kind of parochial interests.
Yeah, thank you very much. Time is run out, so I don't see any hands anymore on the floor. Thank you very much, the speakers. It was wonderful to listen to you. Thank you also to the discussion. And my last point is there will be a poster session today, and you have all received this sheet. You should evaluate the posters to get the best poster award, to decide about the best poster award, which will be given this evening at the conference dinner. Thank you very much, and enjoy your break.